This is my thing, and I really appreciate having the opportunity to be with you this afternoon. For those of you who do not know me, my name is Wendy Kirkland, and I am the author of a number of books, and today we're specifically going to be looking at the patterns that are involved in the price surge system. And so I'm actually going to discuss two patterns, a long and a short, some of the details of a strategy, and you will be able to use this information with what you're doing right now. You don't need to buy anything or get involved. Of course, that is going to be an option, and there will be a special offer at the end of this presentation, but you will be able to use this information right from the get-go. That many traders come to the market by different paths, and some maybe you have had someone else in the family involved, a father, a grandfather. Usually it's the men in the family, or something in your education. Perhaps you have a financial background, or something within your job professional has brought you to the market. But many people, many everyday people, come to it by way of needing some help financially, and it comes around that they become involved and interested in the market. And that was the case for me. That my husband and I owned a gift shop for 25 years, and this was our livelihood. We hoped that one day it was going to be our retirement. It helped us raise 3 children and put them into college. And one day back about 10 years ago, there was it was Hurricane Francis actually that came through. At that point in the mountains of western North Carolina, it was a tropical storm when it got to us. But it flooded the area, and our gift shop was totally wiped out. All the merchandise, all the extra stock, all our paperwork, everything, brochures, was completely ruined and had to be thrown away. And we didn't have any flood insurance. Most of you know you need, for a flood, you have to have special insurance. Your regular liability insurance doesn't cover that. And so we were totally devastated. We had no options. Everything we had was tied up in our business. And so desperation really brought me to the stock market. And I took a couple little classes and taught myself option trading. And because I'm an artist, my husband and I carved very realistic decoy ducks and birds, and I painted them and did oil paintings and so on. So I come from an artist background rather than a financial background. And because of this artist's viewpoint, I guess you would say, I have a different perspective on the market, and I see things a little differently. And that's what I'm going to show you today. My personal goal at that time particularly was for financial independence. We needed to do something just to be able to keep our house from going back to the mortgage lender. And eventually, when I became successful at trading, that desire then grew to sharing and helping others to achieve the same wealth building objective of financial independence. And so I have done that through a number of strategy books for both long and short trades. I do weekly newsletters that post trade candidates and additional educational education and commentary. I have coaching services, and then I also do 4 advisory services. So how did I win 85 massive winners in the past 14 months, where 88.5% of all the winning trades more than doubled in just a few days? And the elements of that success was: 1, the leverage of options, buying weekly and front month option expirations, and trading equities that were primed for really big explosive moves. And this is that pattern that I'm going to describe and show you how to set up on your charts, and that will project this information to you. So let's take it step by step. Normally, you have all the equities that are available. You have your pattern, whatever you're using as your setup, and then you have the various option expirations. And these elements go into a funnel, and hopefully coming out the bottom you have your winning trades. So what I hope to be able to show you today is how to have the candidates and the winnings come out the wide end of the funnel. So options hold the key. That's the beginning place that we're going to start, is the leverage of option trading. And so let's take one particular trade to illustrate this. And we're going to talk about a setup that happened on December 16th for Salesforce. And at that point, the stock price was 50.50. On December 27th, it rose so that it was 54.45. And that is almost a $4 move and was a 3.7% gain. On the 16th, the December 4th weekly option strike of 51.50, the premium cost was $1.04 per share, or $104 per contract. On the 26th, the bid when you wanted to sell was $2.93 per share. That is a gain of 181% in over those 10 trading days. And so in the stock market, you have a gain of 3.7% versus 181% gain in the options. So if we take the total investment of $5,050 to purchase 100 shares of that stock, and it earned $400. Or you could have taken the total investment of $104 for that one option contract of 100 shares of stock, and it earned $293. So for the same $5,000 investment, you could have bought 48 option contracts and earned $9,000 in profit over those same 10 days. And so this is an illustration of the leverage that options have. It's almost like renting stocks. I don't know if all of you are trading options or if you're trading stocks, but this is a quick overview of the leverage that comes with option trading. This is a very simple chart of Salesforce. And as we proceed, I'm going to add indicators on this so that we can help decide and know ahead of time when this stock was going to make this nice $4 move. If you look at this, there was a drop, it flattened out, and then it started to move up. But how would you have known at this point that it was going to move and have this nice run up? And this is the point where we exited on the 27th. So I'm going to run through and I'm going to give you what you need to be able to see that this stock is now ready to have this explosive move. But before I do that, let me go through and cover some of the other elements that I said that make this whole package for success. Weekly options was the second success element. So why weekly options? I'm going to run through several slides that have listing all of the advantages, and I'm going to go through this very quickly, but there's a lot of people are really scared of weekly options, and part of it is the fact of the limited time. So let me run through this and then you'll be able to see the advantages and how it works. I've actually kind of been on a campaign to share the benefits of weekly options for probably the better part of a year, and I apologize I'm going to move through it quickly, but I think it's important that you understand weeklies are celebrating their 3rd birthday, and they're still new enough that many traders just don't get the advantages. This is an area I'd like to focus on, and then we'll look at my patterns. As traders, we've been taught not only the value of time, but also to make sure we purchase extra time so that our trades have plenty of time to unfold and play out. And this is not the thinking behind weeklies. With weeklies, the aspect of time works in the reverse. We are not looking for extra time to allow our trades to play out, but providing we have the direction of the trade right, we're seeking protection against the market's fickle change in direction. We're using the short-term expiration to our advantage. So let's look at some of the benefits. One, the weeklies are very cost effective. They are a fraction of the cost of monthly expirations. They have exceptional flexibility. They're a useful trade vehicle for numerous strategies for straight calls and puts, spreads, covered trades. Long-term trades are subject to market changes. With short-term trades, you trade what the market hands out. Since weeklies are new every week, a trader can pick and choose to enter at the trade at the moment the action is getting ready to happen. There's no need to tie up capital waiting for an equity that is going through a pullback or a consolidation period. You enjoy 52 expirations a year. Weeklies are available on indexes, stocks, and ETFs. Exchanges often offer new weeklies on companies that will attract attention each week, and these equities usually have high volume. 1 week a month, all optionable equities become weeklies. Weeklies are a short-term chartist dream. Where will this equity be in less than a week is the question that you have to ask. You don't have to worry about where it's going to be in 6 months or a year. The shorter time frame allows for more accuracy. Weeklies can be used in conjunction with news announcements, earnings reports, FOMC minutes, and other pending reports, economic reports. Weeklies remain more reasonably priced even during periods of high volatility. And once the news is released, then weeklies suffer less volatility crush than monthly options do. There's even more advantages. There's the Greeks. Weeklies inherently offer a greater delta. Weeklies don't suffer from high theta. The time value is less of an issue. Cheaper prices mean you can purchase more contracts for the same total investment, as we saw in the illustration for the trade we looked at. The additional Greek benefit is gamma is explosive, so that with so little time value, quick price moves before the market can change direction compounds the benefits and leverage of option trading. And the exchanges have recently received permission to offer weeklies for 5 consecutive weeks out in time. But then there's the warning, in a sense, of buying too far out in time reduces the benefit. So you want to stay within the first weekly or second weekly. If you go out 4 weeks or 5 weeks, you might just as well buy the monthly option. My personal goal, as I mentioned at the beginning of this presentation, is to help people achieve financial independence through option trading by utilizing weekly options and my special patterns and various strategies, and all of this supports my goal. So I'm going to reveal to you the steps that I use to double my money quickly 39 times in the last 8-month period. where I was in trades for less than 3 or 4 days. And this is a strategy for everyday traders, for the everyday person like me. I'm a mom and I'm a grandmother. I just am just this everyday person that has average education, and yet anybody can learn to do this. Yes, there was some losers in this period of time, and there was actually 12 to be exact over the 8 months. But when you win most of the time and you're winning with the leverage of the weekly options and you have stops in place, then the winners outpace the losers. And I hear from traders every day who are experiencing great success using this strategy and these steps and these patterns, and the success that they have is life-changing, and that has been so unbelievably rewarding for me. And as I mentioned, the strategies and what I teach is for the everyday trader. It's usually investing an amount of about $600 per trade. If you have a huge trading account, you can multiply that investment. But this is, again, a starting place, a place that the everyday trader can usually manage and do really, really well with. We're not just talking about option leverage, but we're also talking about weekly option leverage. And I have found that if you can zero in on stocks that are going to move between 2.5% and 4% equity move, that will equate to a double in the weekly option premium. So that's all we have to do, is we have to look and find and zero in on the stocks that are going to have consistent large moves. And the price surge system shows you how to do this, and you're going to be able to follow that as we go along. So let's look at another example and put this in practice. That we'll look at Coca-Cola. That had we purchased calls mid-trading day on December 17th for 65 cents a share or $65 per contract for the December 4th week 38.50 strike call, and let's say we bought 10 contracts for a total investment of $650. You sell at the end of the day on the 27th, and that happened to be the expiration day for the 4th week option that we purchased. The call contracts were worth $2.05 or $2,050 for those 10 contracts. That's a gain of $1,400 or 215%. So Coke's price when we entered was approximately $39. When you sold it, it was $40.60. That's $1.60 change in price. That's a nice hefty 4% increase in the stock's price over those 9 trading days, yet the option increased 215%. So for those 9 days, you controlled $40,000 worth of stock. You had 1,000 shares, you had 10 contracts times the approximate $40 that it was worth, and you did this with an investment of $650. So during that period, you more than doubled your money in those 9 days. And the point that I'm trying to make here is it doesn't take a huge move. It doesn't take trading stock on Apple, though you could, but it just takes zeroing in on stocks that have consistent 2.5%, 4% moves over a short period of time within your weekly option range, whether it's out 1 week, whether it's out 2 weeks, whether you're buying the front month, within the period of time that you're determining that it will take to move. So here's Coke on the 17th. So what's going to tell you that it is ready to explode? That if we look at what's happened in the past here, we've had a period of consolidation for the better part of the first 2 weeks. it dropped down, it consolidated again for a couple days, it dropped down another time, and so now we've had a couple little positive candles. It looks quite like this period right here. It could have looked quite like this one or this one as well. So what's going to tell us that this is the time? This is when it is ready to really move and explode upward. So we'll start adding some. The first one that I've added to the bottom of the chart here is the price percentage oscillator. And if you're not familiar with that, it is quite like the MACD, the MACD. It looks the same, it's read the same. Actually, if you line them up, they look almost identical. I just happen to like the formula of the price percentage oscillator a little better than the MACD. But the principle behind the PPO or the MACD, if you're not familiar with it, is the fact that you're working with the solid black line is the PPO line, and when it crosses over the red line, which is its signal line, it is giving you a clue as to the direction of the price. So if we look here, it crossed upward, and when we look, the price has gone up. When it crossed down here, it had already dropped a good bit, but anyway, this signals that the price is going to drop. Here we have another cross up. We have price went up a little bit. We have a cross down, and it shows the drop. So anyway, that is the way that the PPO and the MACD work. The histogram here can also give you information that often it can be used. It's a more of a leading indicator, and it can be used to give you a heads up that something's brewing and maybe something's ready to change. It can kind of give you a divergence of letting you know when it's differing from what's happening in the price. Here we have it slanting up, which signals that something might be brewing and it's going to go up, and what's happening in the price actually is it's just kind of flattened out. So let's continue on and go and add another indicator. I have now added the ADX line here underneath the PPO, and its placement is important because what I'm going to show you and what my artistic self discovered is the pattern that these two indicators form together. That I call this pattern right here a squeeze. The lines have come in very close together. The PPO and the ADX have nothing to do with each other. They're separate indicators. They're read separately. But I realized that anytime these two dent in together, and then it's not just denting in where they come close, here, but when they push away from each other, price goes up. Here it went, they pushed away from each other and price went up. They pushed away. This is just a little one. And how tight they come together is subjective. It doesn't really mean because it's tight here and not so tight there and less tight here that this particular tightness indicates that this explosive pattern is going to be any stronger. At the same time, it very well may. It really is. You can sometimes have the lines come in like this and have this be the big move. There's other confirming indicators that are added to it that really tell you. But let's continue, and you can see what happens. That the lines came in very close here. They pushed away. The PPO crossed up. The ADX headed down. And look what's happened. Price shot up. Now we'll look at the full move for Coke and what happened. This is back here, a different view of it and adding more days. This is the point where the lines pushed away, and look what happened. This is a move that lasted for longer than a week, and that was a really nice, profitable move. Here's some patterns that show the squeeze pattern. Here you have Amgen. You have this tight area, the lines push away from each other, and you have this explosive move. Facebook come in real close, they push away from each other, and up it goes. Now the squeeze goes through 7 particulars, and we don't have time to go through all of that tonight. The price surge system book goes into all of those details, and every single squeeze has to go through 7 stages to complete. But here again is a Tesla. This is a 60-minute chart. I didn't look at what the previous chart time frames were, but this pattern works on any time frame. Here again, the lines came in very close together. They spread apart, and it took a little bit of while for the momentum to really kick in, but then we had a huge move from down in the area of 117 up to 142. Can you imagine? That was just over a few days. So the idea is once you spot this squeeze pattern and you have the confirmations that tell you it's time to enter, and here's another example of it, and the lines push apart from each other, you're going to have this upward move. That to show you, instead of showing you what a squeeze looked like after it happened, I want to show you what it looks like as it's forming, because as traders, this is the point that we would be having our attention drawn to it and getting ready to trade. So this would be what a new squeeze formation look like. The lines have come in close together. This would be your cue that you're getting ready to consider entry. You want this to pop up and you want the lines to start spreading apart. And bam, that's exactly what happened. They spread apart, and you've had a huge pop up, and then you've had this nice uptrend that went from $82 all the way up to 91. That's a really nice move. So on this trade, the one that we just saw, and the point I want to remind you about is the fact that it doesn't take a huge move. All you need is the 2.5% to 4% equity move will often equate to a double in your option premium. So on Deere midday trading day on the 4th of December, after the big move, let me pop back up here so I can show you what I'm saying. So I'm not saying this big move right here, because that would have been hard. It would have happened early, probably on a morning. I don't know if this was earnings or what, but anyway, I'm not including this big move. I'm taking and saying that we entered at some point in here after the big move, because we wouldn't have been able to catch that. So after the big move, the price per share was $1.45 or 145 per contract for the December 1385 strike calls. And let's say you bought 4 contracts. We're keeping it again in that $600 range that would be manageable for most people. And so your total investment was $580, and you sell at the end of the expiration day, just before the day closes on the December 20th. The contracts were worth $4.90 or a gain of $1,960. Whoops, I'm sorry, for a total of $1,960 for a gain of $1,380. That was 238% gain. So Deere's price when you entered the trade was approximately $82, and when you sold it was $89. So that's a $7 change in the equities price, and that's a whopping 8.5% increase in the price over those trading days. And yet the option price then increased 238% over that same period of time. Again, this illustrates the leverage of option trading over buying the stock outright. So again, I point out that the pattern appears on every type of equity. So here we have the Dow Jones Industrial Average, and here we have the squeeze pattern. You have the cross. You have the price goes up. Now, when you incorporate this information on the indices, it also gives you then this support of knowing that the trend pattern, the pattern of the indices, are supporting the direction of your trade. And as I mentioned, it works on ETFs, it works on the indexes, it works on inverse ETFs, it works on equities, and it works in any time frame. So you can have, this is a 15-minute chart, and here's a squeeze and popped way up. Now I'm going to point out here, here's another one. Here's a little squeeze and it popped up and then it reversed and crossed back down. Here's another one that popped up and went through more of the stages. So there are other confirming indicators that maybe would have kept you out of this trade. You would have had to trade really quick. You had a gap up and then it popped and then it dropped back down. It reversed that day. So there are confirming indicators that maybe would have kept you out of this trade, but had you enter here knowing that this is going to be more of a substantial move. If you are a day trader using 15-minute charts or 5-minute charts, but it can also be used all the way up to weeklies. I know of traders that trade weeklies and they buy leaps and they make purchases and then they just walk away and they don't have to even look at it, but maybe once or twice a month as the pattern plays out. When you see it's time to then trade the plan and you add the confirmation signals and then you have a huge winner. Here is a very nice squeeze pattern on Cliff's Natural Resources, solar. And a point that I want to make is the fact that you want the confirmation signals before entry because not every squeeze is the same. We saw that on a chart earlier, and here is a perfect example. You have the lines came together, they pushed apart, and yet what happened here for 4 days was the fact that it went flat and then it re-squeezed. This is a term that will be in the price surge book. And there actually kind of was a second re-squeeze before this actually ever really took off. And so the confirmation signals would help to keep you from having your money tied up during this period of time. That you can see the pattern, you can see that this pressure is building in this pressure cooker, but had you purchased a weekly option at this point, it would have fizzled out and you would have either closed the trade when it moved against you, or if you had held it all the way till expiration thinking it was going to go back up, it would have expired, probably worthless or close to it. You just want to be able to enter the trades when they have the confirmation signals so that you know for a fact that it is going to go up and continue going up. Here's another that when you add the confirmation signals, that I made a point here of saying it's like a red light or a green light, that here you had every indication that it was going to go up, and the cross of PPO was enough to do a little bit, but then it really flattened out for a number of days, and you wouldn't have wanted to have your money tied up for this period of time. You would have wanted the confirmations to know that this was a new trend that was starting. So that you learn to pick the winning patterns. That here we have a squeeze, and this amounted to a $2 move, which was approximately 4%. So even this little move here would have doubled the option premium over just these couple days. Here's another squeeze pattern. This was more like a 9% move, a $4 move from being 48.50 up to 53. And again, you can see how the lines push away from each other, and that kicks us into gear and gets this new uptrend started. On the trade that we just looked at, these are the trade results that had you entered on August 8th, purchasing the August 3rd. That was 2013. If you'd purchased the 50 strike calls with 8 days until expiration for an ask premium of 69 cents per share or $69 per contract, you could have purchased 10 contracts for a total investment of $690. Again, that's in that manageable range. You sold it on August 13th for a bid premium of $2.58 per share or $258 per contract, or $2,580 for your 10 contracts. That's a profit of $1.89 per share or $1,800 for those 10 contracts, and that was a gain of 274% in those 4 days. So this is the point that we're getting at now. We started off on an earlier slide where we had the funnel reversed the other way, and we were focusing in the expiration, the equities, and it was all then coming out the narrow end. What we want to do is to funnel the information through the small end and have the profits come flowing out the wide end. So this is again a repeat of what we saw. We had all the variety of expirations that were available, all the equities that were available, all the patterns and setups that were out there, and they were coming down through the narrow end. And we are going to reverse that we are going to take monthly and front month expirations. We're going to take stocks that have large price moves, and then we're going to take both the P3 and the P3.5 pattern. Now the P3 is the squeeze that we just discussed. The P3.5 is the short pattern, so that this shows you when the market is going to have a large drop down. And with you being able to refine and define one, your expiration period, one, just a smaller number of equities that have these large price moves, and then these two specific patterns, you are narrowing down the job, one, of looking for what's going to move, but you're also going to be able to have more specific information and know that the potential is on your side for these big explosive moves like we've been looking at. So how is it possible to become an expert on just a few big move equities? You're going to find and have a list, a working list of equities that potentially regularly have these large moves. And it doesn't matter what direction they move, whether they move up or down, because you are going to be ready to be able to trade both directions. So explained, and I showed you the P3.5 squeeze that's discussed in the price surge system book. And so let's look at the P3.5, the short squeeze pattern, so you can see the difference. Now we're using exactly the same indicators. See, we have the PPO and we have the ADX, but what we have done is we have changed, and we have put the ADX on the top over the PPO instead of underneath it. And what the difference is, and we're going to look at a number of charts because this one is a little bit harder to pick out. When the ADX is on top of the PPO, the lines, and I'm going to use this side as a explanation, you see that they mimic each other. They move in tandem. We have the PPO kind of rising here gently, and here we have the ADX rising. Here this is turned down, the PPO is turned down. So they mimic each other. They are like railroad tracks. They're running in tandem. This area is different. It's the only place on the whole chart really that is different where it is not mimicking it. And so this is one of the stages of the P3.5 trade, the short trade. Here we have the lines coming very close together, and there are going to be, again, confirming indicators that also will give you a heads up that this is the point that you're looking at, probably on the 20th or 21st of this month. You would have had the PPO cross, and the PPO cross, I'm saying it would be up here, across down, and you would have had other indicators saying that this move was getting ready to happen, and the drop starts, but the significant and deep drop happens when these lines push away from each other and create this kind of V pattern. That it started right here, and this deep drop happened when these lines push away from each other. We're going to look at a few more so that you can start picking this out. Here's again John Deere's chart. You have this area where the lines have been mimicking each other. They've come in kind of close, and then they push apart. They push away from each other and make this V pattern. And look at that drop. And flip back. Again, I just point this out so that your eyes start seeing it. Here, these areas are areas, again, where the lines mimic each other. They're very close to being the same. And again, this is very evident, this area where they jut out from each other, are repelled from each other. Here's another one that again, this is the initial setup of the P3.5 where you had the PPO cross down. They've been kind of mimicking each other and have come in close, and then this place where they push away is where the severe drop comes in. Now here we actually have another short drop that took place. It was almost as if this didn't finish, and it went flat, and then there was this little last push away V down here, and then they mimicked each other as they continued on. Here's another example. This is where they are running in tandem, and you have the PPO cross down, and then this stage where they push away, and this is a second leg down where they push away again. So you have this big, huge trend down. So let's follow a P3.5 trade signal from start to finish. Again, this is what you would be looking at as a everyday trader. This is the pattern that you would start to see. You would see that the lines have flowed in tandem. They've come kind of close together. You right here have a PPO cross down, and you see some selling that's taking place. Prices dropped, and this would be a heads up to say that a P3.5 pattern is forming, and it would be time to consider entering a short trade. So we would enter right in this area. This is the next day. It opened, it gapped down, and again, you can see that the ADX is heading down. We have our our PPO cross with some space between the lines, and this is where we would enter. You wouldn't have been able to catch that way up here, so we'll do it at the point after it, the gap in the morning. And this is what happened. You have the drop continued, the price continued down, and if we look at our indicators, you have the spread of the lines and where they push away from each other. And this is where we would consider exiting when they've kind of lost, I don't know, the zip as far as pushing away from each other. And it's starting to flatten out. There's no reason to be greedy, and you just say, okay, it's time to move on to the next trade. So this is that we would have not gotten in on the gap. So after the lunch break on December 20th, you noticed the pattern on Johnson & Johnson as the PPO crossed down, and you purchased the 87.50 strike for 55 cents per share, or $55 per contract, and you purchased again 10 contracts so that you had a total investment of $550. And mid-morning on the 27th, you sell for $1.15 per share, or $115 per contract, or $1,150 for your 10 contracts. This is a gain of $600, and it was 109% for that 7-day period. So we're wrapping things up here. That the price surge system book covers all of the details of the P3.5 pattern, of the P3 pattern. It goes through all the stages that these patterns go through, and there is also a DVD that details both long and short patterns and the stages. It highlights the confirmation signals as well as the stages. And when I say stages, what I mean by that is every single pattern has to go through the stages. So these points in the pattern give you not only entries and exits, but it also gives you perhaps a second entry. It gives you your stop. It gives you a time where you can take it easy and relax a little bit, knowing that the pattern is unfolding and it's on track. And then it gives you exactly when to exit. These same details are available in the book, in the DVD, and are explained for the P3.5 short pattern that we just discussed. So the information helps to keep you out of the trades that are not quite ready, haven't developed quite enough, and aren't quite at that explosive point. And then it shows you when exactly to get in and all of the other stages that I just mentioned. So slipping through the narrow end of the funnel to burst out the wide end by trading both patterns. If you look at this, where you have the chart set up with both the same ADX indicator on the top and the bottom of the PPO, look what happens, that you have this period of time where the PPO and the ADX lines are mimicking each other. They come in a little close. You have your PPO cross down. You have this short drop, trend drop here going short. You're buying puts, and you have the lines spreading apart. And while this is happening, look what's happening here. You have a P3 squeeze forming, and you then are in a position to have that pattern develop. And again, when the lines cross and push away from each other, so you can flow from one pattern to the other, going short, long, and perhaps up here will then end up being another short pattern. And you will have all of the details to know exactly that this is the one that is going to be the explosive drop down, this is going to be the explosive drop up, and perhaps this one will be another big drop down. And these are the details that are incorporated within the book and within the DVDs. And not only that, there is a newsletter that kind of gives you a list of equities that are forming these patterns. But here's another example. This is Union Pacific, and the point that I want to make again is how you can eventually end up with a list of stocks, and you can just go from one pattern to another. Here you have the P3.5 forming, the lines have spread away. Then you have the P3 squeeze that has formed, and again the line spreading away, and you have this wonderful trend up that lasted longer than a month. So I kind of mentioned that there's a newsletter that what makes the P3 surge system even better is first you have the chart setup, you have the confirming indicators, you have all the pattern and strategy details, including all the stages that each of the patterns goes through, showing alerts, confirmation, stops, second entries, when to relax, exits. But then you also have access to a newsletter that lists stock candidates that are just starting to create the patterns, the P3 and the P3.5 pattern, so that you're aware and can watch them give the alerts that you've learned about from understanding the strategy details and the pattern details, so that you're all prepared. You've looked up on the change, you've decided exactly what weekly expiration you're going to get into, and then you're waiting for the confirmation to take place, and you're all set to push the entry button when the trade confirms. The result of this is that there's always a trade brewing. It doesn't matter whether it's up or down, because you're in a position that you really are able to focus in and are able to recognize both the long and the short patterns, and then you're ready to react. So you have now coupled the leverage of option with the leverage of weekly options, buying weekly and front month options, and you have the winning patterns. You know that this can be, through the examples that we discussed, that it's affordable, that you can certainly see that you could make a very nice living with modest investments of in the $500–600 range. And so this really is a program for the everyday trader. And the patterns then help you zero in on equities that are going to have the huge moves. And this truly can be life-changing as far as bringing about financial independence. There's a special offer for you all for attending the webinar this afternoon, that if you want more information, you can call the support number 1-888-233-1431. You can email. I have a website, wendykirkland.net, that lists all of my different books and programs. But if you will copy and paste this link that is down here on the bottom, you will then be presented with a special offer for attending today. I'm going to see if I can get back to your questions. All right. Thank you for posting the link there on the page for me. I appreciate that. Are you there, Yana? There we go, the general chat room. Yes, I have them now. All right, let me see if I can scoot back a little bit. I'm seeing the question about the PPO and the ADX. My favorite charting that I used was stockcharts.com, but most of the brokers charting programs have PPO and ADX. If they don't have PPO, you can use the MACD, and it really creates the same pattern, and that is a very common indicator. David, I see your question there about what day do you buy your option, and it really depends on what day the pattern forms and what day you have the confirmation take place. So if it were to weekly options expire on Friday, and if I was trading, say, a 60-minute chart, and I knew that the pattern might develop over 3 or 4 days, I would have a choice really of buying next week's option on Friday or waiting till Monday. And it would depend really on if I thought the pattern was going to bring about a gap up, then I might go ahead and purchase on Friday thinking that Monday would gap. I wouldn't want to miss that. And if I had gotten the confirmation signals, I would know that the price was going to move up anyway, and so I might go ahead and buy on Friday. If I saw a pattern develop on Monday, I might go ahead and just buy that week's option where I had Monday through Friday. So it really depends on when you get the confirmation signal as to which option expiration you choose. And this is information again that's covered in the book and just poses all the different choices that you would have and leads you to be able to make the right choices for what's happening in your circumstance. I'm seeing a question about does it work for Forex, and I have a number of trading friends who use the P3 and the P3.5 pattern in their Forex trading, and the pattern truly works for any type of trading. You can use these patterns to buy stocks outright. I just am all about the options and weekly options, but you can really use it for anything that is chartable. Let's see if I can see another. Is my system available for auto trading? Yes, it is. The price surge system offers auto trading. Thanks, Steve. I appreciate that you enjoyed the presentation. I feel like what I shared today, that the price surge system book really helps you zero in on all of the details so that every single chart you look at, you can sit and say, there's a P3 pattern and it's in the fourth stage. There's a P3.5 pattern, it's in the third stage, that it's okay to be able to get a second entry into it. I missed the first one, I'm going to get in on the second. it really helps with all of the details. But even with what you learned today and what you saw, I have no doubt that all of you will now be able to look at any chart and be able to recognize those two patterns, and it's going to help your trading. And I'm pleased to be able to share those details with you. I'm seeing you ask about a filter for stocks to choose for the P3 system or for the PSS system, and I really have not ever found anything that really works well. I have tons of lists that I juggle stocks from one list to another as they're dropped. Then I think, okay, then they're going to the list that P3 is going to start forming and so on. My son Patrick helps me to do this, and we kind of trade together. And the reason for that is the fact that, yes, you can find indicator scans or whatever that will pick out, say, something like a PPO cross or a MACD cross, but it doesn't help as far as the ADX. It doesn't help as far as spotting the visual pattern. And each stock, when you look at the numbers for the PPO or the MACD and the ADX, the numbers are all different. The ranges are all different. So I have never found anything that works really, really well. I see Michael down here is asking what the PPO indicator is. That's the price percentage oscillator is the PPO. And again, if you can't find that, you can use the MACD. It says if you fail to sell the option on the last day, are you stuck with the stock? No, you are not. If you have value in your option, I'm sure that you would sell it and take your profit. Most brokers will go ahead and sell it for you if you have profit in your option. If your option expires worthless, where it has no value at the end of the week, it just expires worthless. That's that. So you know right from the get-go, on the day that you are selecting your option, what your full risk is. That as we were running through and I was saying, you bought 10 contracts for 85, say $65, your total investment was $650. Right there, as you enter, you know that is your total amount at risk, is that $650. If you choose to sell midway, it's gone against you, and you say, okay, this isn't working this time, I missed it. You get out, you preserve whatever balance is left. Perhaps you sell and there's $350. So you have risked and lost $300 and you preserve the $350. And that is part of the point of the patterns in the stages that I've discussed, is the fact that it gives you when to when you're stopped out, when you should sell the trade because it has moved against you. There's no guessing about it. It's right there and in the picture that you're seeing, and you get out and cut your losses short, wait for it to confirm again. It may be the same stock and it may happen 3-4 days later, and that's part of the game of trading options or trading period, is the fact that you cut your losses short and get out. You don't get scared and not trade anymore. It's part of it. And then when you get back in, the profit that you have is more than covers the loss and then some. And you have lived to trade another day. I appreciate, John, you posting the price percentage oscillator there. Helps somebody to actually be able to see the words and have it connect. I work with several online brokers, Dave, and actually per SEC regulations, I'm restricted from actually giving or recommending a particular broker. That when you check in, if you're interested in auto trading, there is 3 auto brokers, 2 are in the States and 1 is an international broker. But there are all kinds of online brokers that are great, and their platforms are very easy to use and they're very user friendly. They have, many of them have really great help, um, where you could actually talk to someone on the phone, or they have the little live chat boxes to get questions answered. And so it really just takes a little bit of investigating, where you look at the site and decide which one offers the tools, whether it be charting or whatever the other bells and whistles that you may want, and decide then which is best for you. And the big thing, often it just comes down to their fees, and most of them are um, comparable. Some are a little more expensive than others, but most are pretty close. James, I see your question about the Qs option trading. There really isn't any reason that you would want to choose this. The patterns are pretty much the same that you have learned in the Qs. It's just that the merit program focuses on the Qs, where the price surge system is open to the world of other equities, and that's the main difference. The big benefit, I guess, is the fact that it comes with the newsletter. On their newsletter comes out twice a week. It's posted on a website. It comes out on Monday and Wednesday, about closing time in the afternoon for 4:30, and the newsletter lists candidates for both the P3 and the P3.5 on those 2 days. So it really gives you a chance. These are not equities being listed that have already played out, but are ones that are just beginning to form. So you really are able to zero in and watch for those confirmation signals. And depending on whether the market is supporting trades, calls to the upside, or whether it's puts, you have candidates to be able to watch and to zero in when you get the confirmations. David, you'd be surprised. There is some theta decay, but not a whole lot in weekly options. That I had mentioned in a example a few minutes ago about whether to get in on Friday. If I feel like there is going to be, like I said, perhaps a gap, I would rather almost take that risk, if you want to say, and hope that I would benefit by what happens on Monday morning versus what's going to happen as far as the decay. I figure, and this is based on the pattern, if I don't get all of the confirmations, I will wait for Monday. But if I have everything in line that says this looks like this is really ready to pop, really ready to move, then I will go ahead and buy on Friday and not worry about what happens over the weekend. Wendy, are you using a stock picking program or just looking at all the weekly options? I'm not using any stock picking program. I review charts, and I really look for charts that are beginning to develop to show these the patterns that we covered today, and I focus in on the ones that do offer weekly options. But you have to remember that coming up onto the second and third week of the month of monthly expiration, then all options are weeklies, and So this, you know, everybody's in the pool at that point. Sebastian's wondering, what is the ADX? It's the average directional index. Well, SA is asking you to enter after a crossover takes place on the PPO, and that is part of the pattern setup, is a cross of the PPO, but it also, you're having these other indicators, not a lot, a couple of them, that give you the confirmations that shows you, yes, there is the energy really building up in the pattern to actually have it move up. I use the default on the PPO indicators, the 1226.9, which is exactly the default for the MACD. So you're right. That's what I use. I don't have any way to change the charts and show you about the MACD and the PPO as far as how they compare, but they are almost identical. I do not, in the price surge system, I do not use spreads. It's straight calls, straight puts. And as far as stop loss, it is really based on a stage of the pattern, and it works out sometimes to be about 20%, but again, it's a pattern that you can sometimes have within the, I call it unfolding of the pattern. You can have the indicators test support, and sometimes they bounce and move up, and so rather than it being a strict percentage, it actually really is and works very, very well. It's a stage in the pattern that actually gets you out of a trade that moves against you. The oh gosh, Sebastian's asking how much the system is. I don't really remember how much it is. I think for the special, again, if you will either click on that link or copy and paste it into a tab, it will take you there. They are offering something special where you get the book free, you get the DVDs free, and what you are subscribing to or paying for is the twice a week newsletter. And I think it is just under $200 for a quarter, so that you are getting 2 newsletters every week for 3 months, listing candidates that you don't have to find yourself. They're right there showing you that they are creating the patterns that we discussed in the slides this afternoon. And you can then just set your charts up, watch for the confirmations, and I think that is the price. I think it's, I forget if it's $197 or $195, somewhere just under $200. Valerie's asking, if the push away occurs near the end of the week, do you buy the next week's option? That is what I would do. It really depends on what time frame you're trading. The price surge system focuses on 60-minute charts. If you were trading a daily chart and were more of a swing trader that was in trades over a longer period of time, then you would want more than probably just the next week's option. So it really depends on what time period you are focusing on. That if you're a day trader and you're trading 30-minute charts or 15-minute charts, you might buy this week's option and not next week's if the trade is going to play out today. Are there programs out there that chart commodities like these? Not that I know of. I have really focused on equities and ETFs. There isn't any reason that the patterns wouldn't work on commodity charts, but I'm not aware of any. Well, thank you. I appreciate that, Sherelle. That's very nice. That, as I mentioned, my thing is trying to help the everyday trader, and I feel like this is my gift to give back and to share this pattern. Like I said, I am approaching trading from a different perspective, from an artist perspective. I see patterns, and they are not the normal thing that is discussed out there, and yet they work. And to me, it's, you need to have a little edge when you're trading, and if this pattern, which is kind of different than what's normal, helps, then more power to it. The TM squeeze and the Bollinger Bands, they are beautiful patterns. I have studied them at one time or another, but it's totally different. You can put those on your same chart and put the PPO and the ADX, and the patterns are not going to occur at the same time. It's totally different. Russ is asking how many setups occur a week when you send out. I don't really send out a signal service unless somebody is signing up for the advisory. And in the advisory, it's more like 3 or 4 a week, maybe 12, 15 in a month. The newsletters list all of the high moving equities that I've found, and there might be 10, 12 of each type on Monday and Wednesday. John is asking, is this in addition to the P3 system? The P3 system was the second book that I wrote. It was the first book I wrote for TradeWinds, and it included the P3 squeeze pattern on daily charts. And that was written a number of years ago, back in, I think maybe it was 2010. And at that point, I had not even discovered the stages of the P3 squeeze pattern. That I knew how it worked. I saw the squeeze and so on, but it was only after I had studied and was sending out the newsletter for the P3 system, and I was looking at charts after charts after charts to post in the newsletter for that system, that I discovered the stages that each squeeze has to go through. And so later then I wrote the price surge system, which included the P3 pattern, where it focused on 30 and 60-minute charts, and then also included the short-term pattern, the P3.5, that I discovered many years after I discovered the stages for the P3. So this has been a growing process for me, and as I learn things, then I have written about them and share it with other traders. So there is more information in the P3, no, more information in the price surge system book than what was in the P3 system, because it covers the stages, it covers trading shorter term charts, and it covers the short pattern, the P3.5 pattern. My website is wendykirkland.net. Yes, there is a price money back guarantee, Howard. The details of that will be on the link that you click on, and it's 100% guarantee. I do have a system for the Qs. It's called the Merit System. If you go to wendykirkland.net, I believe that there will be a link listed there that will give you more information. Otherwise, you can contact the phone number that's up there, the 888-233-1431, and this is a support number, and they will be able to give you the details about the Q system. So Jim is asking, can I explain again what you get for the 197 special? Oh, good. Is that what it is, 197? Okay, I wasn't sure. I knew it was under 200. For that, you get the book for free, and it's not just a little pamphlet. This is a book. This is, I don't know how many pages, 145 pages, I think it was, that covers all of the details for both patterns. It covers the strategy details. It's written in a very easy to read form. There's lots of chart illustrations in there. I'm talking in the book like I'm talking right now. It's like you and I are sitting across the table enjoying a cup of coffee, and I'm explaining what to look for and what to look at. So you get the book, you get the DVDs where I illustrate charts and the stages of the pattern and the strategy, just like I was running through the charts today. And then you get the newsletter that comes out on Monday afternoon and Wednesday afternoon, where there is a sample trade from the previous week's list. There's some commentary, and then there's the list of candidates both for the P3 and the P3.5 system. All right, let's see. I think we're getting close to needing to probably wrap here. There was a lot of questions. Doing it, spinning fast. I'm seeing one here that's asking about the charting service. That I really like the charts from stockcharts.com. Other people, there's some folks that really like Thinkorswim, but I started using stockcharts.com way back when I first started, and you always end up seeming to gravitate to something that you they speak to you, sort of. And I guess because I'm an artist, I feel like the stock charts, it's the colors on the charts, it's the way the indicators are set up. To me, it creates a pattern, something very visual that I identify with, and it just works out best for me and works out well. Robert's asking about the auto trading, and that's with the advisory. Auto trading comes with the advisory, and that's free. I think there's a little extra auto trading fee from the brokers who handle those trades for you if you become a part of the advisory. Now, this is something separate and different from the 197 package that we're talking about today, that includes the book and the DVDs and the newsletters for 3 months and so on. Looks like some of these we already answered as far as the PPO and so on. I think I've touched on most everything, and since the webinar is going to be recorded, you'll have the opportunity once it's posted and the link is sent to you to be able to review it again and slowly and look at as many of the charts as you want and spend as much time as you can with it until you feel like you understand them. I am very pleased to have been here. I appreciate your time that you took away to spend with me. I'm excited to have shared. And if you have any questions, you can always reach me through the website, through wendykirkland.net. I appreciate you very much, and I hope you'll invite me back.